Okay, folks, welcome to the Market Pulse Check. Let's take a look at an article from Zacks before we get into the charts. And it basically gives a review. I'll send out the whole article to you, but it's a breakdown of how earnings season is unfolding. It's pretty much as predicted. We knew that companies were cutting costs to justify their earnings or to beat earnings. They need to beat earnings by a penny so that they could show their shareholders that they're doing their jobs. However, those earnings are coming from cost cuts, not growth. How do we know this? We know this because revenues are missing. Thus far, we've only had 43.4% of the companies that announced on the S&P 500 beat revenue expectations. That's a 0% surprise. We knew this was coming. Earnings growth is up only 1% over the same period last year, with those beating earnings by only 2.1%. I mean, this is really sad. And it gets sadder. If you X out the financials, the banks, earnings are actually down. They are negative by 6.2%. So this coming week, we're going to get a huge deluge of earnings announcements coming out in the S&P 500, and the fact that this market is rallying leads me to only one conclusion. This chart is from Zacks again. They're looking at earnings growth for the final quarter of 2013 to roll in at 9.5%. Now think about that. Earnings are, if you take out the banks, are actually down. When you keep the banks in, they're up by 1%. However, in Q4, they expect earnings to grow by 9.5%. That's insanity. Let's get to the economic data. And again, I'll send this out to you. Just check the email. I'm sure it'll be there. Okay, economic data that was released last week. Empire Manufacturing Survey, market expectation of 4.5. It came in with a huge miss, 1.5. That's versus a prior period of 6.3. Really bad. Other than the Empire Manufacturing Survey, there's not much data out there. Next week, my guess is that we'll get more data out, maybe some catch up from last week as well. And that might put some volatility into this market because right now it doesn't exist. I'll get to that chart in a moment. Next week, we have unemployment rate, average hourly earnings, average hourly work week, new members. This is a forward-looking indicator, average hourly work week. This hasn't budged for quite some time. You would expect that in a so-called growing economy, the average hourly work week would expand because before employers hire new employees, they're going to offer overtime. We're not seeing that. Durable goods orders set to be released on the 25th, and the Michigan Sentiment Survey on the 25th as well. That is consumer sentiment once again. So some market-moving economic data is set to be released next week. However, it'll be trumped by earnings. Let's check out the charts. All right, the Dow Industrials on a daily basis, unlike the S&P 500 and the Russell 2000, the Dow Jones has been a laggard. My guess is we're not going to spend much time on the daily chart. Good volume on Friday. The weekly chart tells a better story. All right, so you're looking at the weekly chart, Dow Industrials. We have yet to break out. We're right at resistance. I think we're going to break through. Why do I say that? Because if you take a look at the RSI, we're breaking through, or in fact, we have broken through resistance and closed there. Very, very important. Volume last week was low, but it rose above the prior weeks. Ultimate oscillator, we're breaking out of that downtrend. We have not broken out on the Stochk RSI, nor have we done so on the slow stochastic. We broke out on Williams percentage R. So by and large, the indicators are implying that we're probably going to see a price move higher this coming week on the Dow Jones Industrials. When you take a look at the Dow Transports, you remember Ralph Acampora was out a couple of weeks ago stating he predicted a breakout in the Dow Transports to all-time highs. He was right. The charts were right. And the transports did in fact break out. For those Dow theorists out there, if you believe in that theory, if the transports are breaking out, you should expect to see the Dow Industrials break out as well. So my guess is we're going to see a breakout this coming week on the Dow Industrials. S&P 500 daily chart. breakout on fairly good volume. I can't attribute it to just simply being short covering. Volume did rise last week. Weekly chart of the S&P 500. I think that we move higher. We got resistance here at 1750. We get a new weekly high above 1750. I think we go significantly higher on the S&P 500. Volume last week, although still below average, rose over the prior weeks. Take a look at your slow stochastics. We had choppy action for several weeks. We drew our trend lines. Bam, we broke out on RSI, or Stoch RSI last week. We're setting up to do the same on the slow stochastic. MACD looking to go positive. Williams percentage R looking to go positive. Listen, folks, if there's a divergence out there, its divergence is this. We are seeing decelerating earnings ex the financials, slow and disappointing earnings with the financials, yet the S&P 500 is breaking out to all-time highs. Robert Shiller, who just won the Nobel Prize last week or the prior week, he made an announcement on Friday saying that stocks are 30% overvalued, and they just shrugged it off. So we're in that silly period. I believe that we're entering the period we're going to see a blow-off top. So yes, we can go considerably higher. They're probably going to chase these stocks higher in anticipation of earnings growth in the fourth quarter. This is what you hear on CNBC. Forward-looking earnings guidance is 9.4%. And until companies start marking down their fourth quarter guidance, the market's going to chase that expectation higher. IWM, daily chart, breakout. Now, when you take a look at this breakout, I'm going to change this chart. Look at your volume, looks good. Above average volume. Now let's do this. When I overlay it with the Bollinger Bands, we have been pressing the Bollinger Bands for quite some time. We closed above the upper band of the Bollingers last week. That hasn't happened in quite some time. And actually, the last time was back in February. And the following week, we sold off pretty hard. As a matter of fact, we sold off for about a full week until we got to the lower band. So I wouldn't be a bit surprised to see a pause in the IWM and possibly a pullback to, say, 107. If we break down to 107, we could quite possibly come down to, say, 104. The XLF weekly chart. Well, all the banks are saying that their mortgage divisions are slowing down. They had to lay off people, but those layoffs are now justifying forward-looking earnings. So although their mortgage business is hurting, they're still making money. They are the leaders in earnings, no surprise there, despite all the new regulations by Dodd-Frank. The two thugs who got us into the financial crisis wrote the rules to fix these guys. Shocking. And despite the fact that they are being litigated to death by the federal government. So they're still making money despite all the headwinds. You can't short the banks. I'm sorry, you simply can't. It looks like we're going to see a breakout on the XLF, and they will lead the market higher. RTH is shocking the strength in this sector. I've never been a big advocate of trying to predict the rationale or logic behind the retailers. They just want to head higher. And when you think about Yum Brands disappointing last week, Coldwater Creek being decimated, probably going out of business, retail is not doing all that great, yet the sector, although lagging the S&P 500, is still not breaking down. XLK, the technology sector, this is a monthly chart. I'm going to drill down to a weekly chart in a moment. We're up almost 4% on the month. I predicted this a couple of months ago, that the game that these guys are going to want to play now are to get the media talking about NASDAQ taking out all-time highs. They're going to need technology. So watch technology. It's been consolidating here for quite some time. It's rebounded off of earlier weakness. It's broken out above the September highs. You can be an owner of the XLK. Now let's drill down to the weekly chart. The only thing to keep in mind how extended, how long this rally has been in the XLK. Doesn't mean you should short it, but just keep it in mind if you're getting long of it, it's getting a little bit long in the tooth. Here's your breakout, weekly chart, XLK. Beautiful, beautiful price action. Volume was weak last week, came in lower than the prior weeks. Indicators are looking okay. You can be a buyer of the XLK for now. The semis, they need the semis. You want to get the XLK moving higher, you have to have your semis, and the semis are breaking out despite Intel, which came out with, of course, disappointing earnings. Up over 1.75% last week on no volume. New members note the volume over the past 2 years. You'll see this in retail. You see it in the semis. No volume whatsoever relative to prior years. And when this sector finally decides to fall, I don't know who's going to step in and put a bid under this marketplace. But for now, they're going to keep the semis moving, keep the party going. And you have to have the semis if you want the NASDAQ to move to all-time highs. The XLU, which was left with all but dead and a rising 10-year bond yield several weeks ago, is now threatening to take out resistance. Now, the reason why you're seeing this is because you have bond buyers in there, and those bond buyers are forcing down the yield on the 10-year yield. What does that mean for the utility sector? Well, it means that they don't have to compete against a 10-year yield. They don't have to pay out higher bond note yields, so that directly impacts positively their bottom line. So I wouldn't be a bit surprised to see a breakout on the utilities because the 10-year yield is declining. Good volume last week. Slow stochastics, a higher low, looking good. MACD may just go positive. Williams percentage R looking good. Another higher low. Whenever you see a double bottom setup above the 80 level or a loop up above the 20 level on the slow stochastics, this is very, very bullish action. Lots of support there. I would not short the utilities, and my guess is that you could see a breakout this coming week. But remember, this is a defensive name as well. These are dividend chasers who are buying these, and folks that are looking for protection. They're not looking for beta. The housing sector, despite the declining 10-year yield, this sector still cannot find its footing. Yes, it's putting in a higher low. This is only a daily chart. For giggles, we'll plot to a weekly chart. Still, no follow through on Friday. It lagged the overall markets. Let's take a look at the weekly chart, see how that looks relative to the other sectors and indexes. Still trading below the 50-period moving average. Good bottoming tails, which is bullish. We have a new higher low, prior low, 164.03. The new higher low is 169.71. If we take out 191.24, you could be a buyer of the housing sector. I like Toll. It's best of breed. TOL, the symbol. The XLP. This is the consumer staples select sector. These are defensive names. Note how the sector has been in a consolidation, yet the RSI is breaking out. If you're an investor that's looking for a safe investment, this might be something that you might consider. If you're looking to hedge your portfolio, get out of some of the beta names, take your profits in some of the higher beta, higher volatility names, and you want to rotate into something safer in case we get a market correction, this is what you might want to take a look at. These are your Coca-Colas, your Kraft Foods, etc. And note how we're breaking out on the RSI. Again, weekly chart, good candlestick action. My guess is that we break out. Note, great double bottom setup on Ultimate Oscillator. Really good setup on Stoch RSI. Draw your trend line up here on slow stochastic. The reason why I do this is to watch for the trend, to make sure that we see consistency of strength throughout, and we're seeing it. I like the XLP. You could buy it on a breakout. The VIX, just a horrible, horrible week last week. This is a weekly chart. We're right back down to the lows. I'm not going to be a bit surprised to see them take this down to the single digits. Let's take a look at the monthly chart, because we've been in the single digits before. Right back here, 2005 to 2007. And that's where you really had your severe complacency. What happened soon thereafter? You had your housing crisis. and the banking crisis. So the monthly chart is, we're only midway through the month. We're entering the back half of the month. This could change on a dime. However, you see a breakdown below 1105 on the VIX. It's a continuation breakdown. We've been in the downtrend channel since 2008 on a monthly basis. You see a breakdown below 1105. My guess is we're going to the single digits. It's a fair bet. So we're not going to be adding to shorts of the Russell 2000 anytime soon unless we see the VIX begin to consolidate, show some bottoming tails, and or we see the Russell 2000 begin to top out. And the fact that it's dancing now on the upper band of the Bollingers, well, the short-term end is near. We're going to get a brief correction on the IWM. That's not going to last forever, that rally above the upper band of the Bollingers. But that doesn't mean it's going to correct and go to zero either. It's just going to be a brief correction, then perhaps a continuation rally higher. U.S. bond, 30-year bond price, not the yield. Take a look. Last week I mentioned, looks like we're going to make a new weekly low. We did, however, we regained our footing. This is a bullish engulfing. We are heading up to the 200-day moving average. You have money moving into bonds. Now, when bonds rally, you'd expect to see some weakness in stocks, so you have a little bit of a divergence here because you have a lot of money chasing two investment vehicles, either stocks or bonds. Usually one or the other suffers a little bit. And in this case, both did well last week, so it's a bit of a divergence. Keep an eye on it. Here's your S&P 500 overlaid here in black, and you can see the divergence. S&P 500 generally rallies higher when you have the bond market correct. Now you had a bullish week last week in the bond market, and you saw a bullish week last week in the S&P 500. And that too will not last forever. In fact, you saw it last briefly here back in 2012, March of 2012. You had a new low put in. Just, again, same chart, weekly chart, a reversal off the lows. Very, very bullish week. The S&P 500 closed up that week, but then we went into a correction on the stock market over the next couple of months as bonds continue to rally. So just keep an eye on this. This divergence is not going to last very long. It's only a matter of time before you see money flows begin to either drift away from bonds, making Bernanke a bit scared, because if they've drifted away from bonds, that means the 10-year yield is rallying, or that means that money is rotating out of stocks and into bonds, and that means that the rally in the overall stock market is going to slow up. This is a chart, monthly chart of the 10-year yield. I will drill down to a weekly chart. You can see our key reversal, new members. We rallied off of the lower band in, say, June, rallied higher to almost 3%. We called for this rally back in December, January, and sure enough, we got it. This rally was enough to cause the housing sector to go into a bear market. If you go back to the HGX, we corrected 20% off the top, putting us into the Wall Street definition, 20% correction of a bear market. And we still see the housing sector as laggards. They may pick up this week. However, they remain laggards. So this pullback, I don't know if it's going to last. I honestly don't. I'm skeptical about it. We have yet to break down. Even after the no taper talk, it's been a fairly orderly pullback on the 10-year yield. We're still above the 50-period moving average on a monthly chart. Let's drill down to a weekly chart. But before we do that, I noticed this last night. Take a look at your ultimate oscillator. Note how we're pulling back. We're hooking up, possibly setting us up for a double bottom setup on the ultimate oscillator. What does that mean? If we get a double bottom setup here, this is going to act as a launching pad. It's a very bullish setup. The month is not over. We could close below 50. So fair warning, don't base your trading decisions off a monthly chart. This is only the 20th. However, if we get a double bottom setup here at 50 and we close there, brother, you have to watch out for what you might see as a consolidation here above the 50-period moving average, that sets us up for a breakout. If we break out above 3% by year end, this market is going to go into free fall. Unless, of course, Yellen is going to come in and say, we need to increase bond buying. And there you have QE4. And don't be surprised if she does that. Slow stochastics, not bad. It's still above 80. Still overbought on a monthly chart. This is not a bad chart, despite no taper. Let's drill down to a weekly chart. I spend a lot of time on the 10-year yield because it's important. All right, last week, very bearish chart on the 10-year yield. Bearish engulfing. We'll probably come down to a minimum. The 200-period moving average, test it. We'll see if we hold there. Again, the month is still early. And that ultimate oscillator that I mentioned on the monthly chart may not hold. But if we pull back to the 200-day and then reverse off of it, you can expect to see some nervousness in the stock market. The US dollar just being absolutely decimated. Closed below its 200-period moving average on a weekly chart. Topping tails, definite resistance here at 81. This is good for the multinational stocks. It makes our goods cheaper overseas. Expect to see the S&P 500 continue. In fact, you might see some sector rotation out of the small caps into the large cap names because the larger caps have higher exposure to the international marketplaces, whereas the small caps don't. The ultimate oscillator on the US dollar is just an absolute mess. There's nothing about this chart that's pretty. It's just an absolute mess. If you're a Forex trader, I wouldn't be a buyer of the US dollar against anything. Baltic Dry Sea Index is a measure of pricing power of dry bulk shippers, which had a massive, massive rally. 2 weeks now of a correction. No shock here. It was very, very overbought. We're above 85 on the RSI. No shock here. Doesn't mean it's going to zero, just a pullback. Keep an eye on these shippers. Eagle Dry Bulk, dry ships, West Texas Intermediate Crude. Remains in a consolidation here. I mean, we thought we were going to get a breakout. In fact, we did get a breakout. There was no continuation breakout above the 112 level. This puts into question really the health of the global economy. If you don't have oil breaking out, yet there's a perception out there that you have massive global growth, well, why isn't oil spiking? Especially in the face of a weak U.S. dollar. Oil is priced in U.S. dollars. Why is oil not rallying? It's a divergence. The XLY, consumer discretionary stocks. These are your Starbucks. This is when people are feeling good. You always want to keep an eye on these. The consumer discretionary charts is a good way to measure whether or not you're going to have people willing to dip into their pockets for a $4 cup of cappuccino at Starbucks. So keep an eye on it. Whenever you see it rallying higher, it means sentiment among the U.S. consumer is still fairly good. And it's a pretty healthy chart. Yes, it's extended, no doubt about it. But it's still a healthy chart. It's certainly not to be shorted, and you can probably nibble on it as well as a long. And that's it, folks. I'm going to begin on the Focus Stocks video now, and if you have any questions, shoot me an email, and I'll see you on the other video.